Okay, welcome to the first Cornell Financial Data Science Seminar for the semester. I'm really excited to have Kevin Webster talk about how price impact distorts accounting P&L. So I've known Kevin for a few years now, and I've known him originally as a researcher and a PhD student at Princeton in the OR department. And then he went on to a brilliant sort of applied in the financial industry career, first at Deutsche Bank, then at Citadel, so always working on these sort of high frequency trading topics and topics that I very much like, and always sort of at the interface of applied and theoretical work and more academic work. So he's had, and today he's coming with his academic hat and sort of his applied experience and giving us a sense of, what market impact really is and how it's accounted in practice. And so I'm really excited to have him tell you more about these topics. So Kevin, welcome to the seminar, and I'm really looking forward to your talk.
Thank you. Thanks, Sasha, for the introduction. And thanks, Roselle, for organizing this. And thank you for having me at CFEM.
Before I let you start, just a few ground rules. If you have questions, please put them in the Q&A, not the chat. And I'm going to put a link to the papers that Kevin will talk about in the chat, as well as a link to our YouTube channel. So without further ado, Kevin, go ahead.
Thanks. So as Sasha said, I'll be talking about how price impact distorts accounting P&L. So as a motivation for this talk at the intersection between price impact and risk management, specifically liquidity risk, I'd like to provide two quotes that I think are quite powerful. The first one is by Ben Bernanke in a speech about the financial crisis, a speech that he gave in 2010. In it, Bernanke states that the notion that financial assets can always be sold at prices close to their fundamental values is built into most economic analysis. And before the crisis, the liquidity of major markets was often taken for granted by financial market participants and regulators alike. This quote relates the financial crisis to price dislocations. And these price dislocations are due to trading. In the world of math finance, we call that price impact. The second quote comes from the seminal work by Caccioli, Bouchaud and Farmer, which I'm going to quote a lot. In this paper, they reiterate the point Bernanke makes about how price impact is a contributor to these liquidity crises, and they propose a solution. To quote the three authors, the practice of valuation by marking to market with current trading prices is seriously flawed. We propose an alternative accounting procedure based on the estimated market impact of liquidation that removes the illusion of profit. I particularly like the last expression, the illusion of profit. And I hope to illustrate during this talk that that's really what's happening, that because of price impact, initially traders and portfolio managers may have this illusion of profit, may think that their current P&L reflects their expected P&L into the future, only to find that these profits evaporate either slowly over time or during a crisis, they evaporate instantly. So these two quotes give a colorful picture, a causal picture, with a chain of three events that lead to this conclusion. The first event is trading. Trading causes market impact. Market impact, in turn, causes price dislocations away from fundamental values. This is not a temporary effect, temporary in the sense of instantaneous. It's an effect that builds up over time and then takes time to relax. And finally, these price dislocations lead to this illusion of profit, this idea that portfolio managers and traders celebrate too early their wins, only to see them evaporate over time. Now, this is a nice, colorful picture, but our goal here is to mathematically formalize this. Now, to be completely fair, the seminal work by Caccioli Bouchaud and Farmer, does provide a quantitative framework, and it to some degree is more general because it allows any price impact null. But I will try to have a more math finance point of view to this problem, and I will try to prove specific results under specific models with an emphasis towards the end on closed form formulas. So this is a talk about price impact and liquidity risk. So I'll give a quick refresher of both for the part of the audience that's used to microstructure and the part that might not have seen this before. So at its core, price impact is a causal model. It's a causal model for trading. It states that if you hadn't traded, the price wouldn't have moved the same way. The way economists would phrase this is as a counterfactual. Trading of stock caused price moves for the stock that otherwise would not have happened. Traders prefer the terminology, what if? What if I had traded faster? What if I had not traded at all? To illustrate this, consider the following simulation. So I start off with a baseline trading speed, which is whatever the historical trades were on my data. And I observe a price path. This would be this red price path there. And I may ask the question, or my trader may ask the question, what if I had traded faster? What if I had traded slower? And the answer to those what if questions, to these counterfactuals, as economists would call these, are the green line and the blue line, which are simulated lines. They do not exist in the historical data. You have to use a model to achieve them. And so the intuition here is that price impact causes the price to get pushed further if you trade faster or more aggressively. And if you trade slower or maybe not at all, the price push would have been lower. And eventually all these price dislocations all revert back to some unperturbed trajectory. So this is at a very high level price impact. Obviously, I'll provide more concrete mathematical formulas and definitions later in the talk. But I think it's important to have at least an idea of what price impact is supposed to achieve. In practice, the industry uses price impact models for transaction cost analysis, often called TCA, and optimal execution. There are plenty of other applications, but these are the two most canonical ones. To give an example, I'm going to quote Bouchaud and Wang. They are two senior quants at Alliance and Bernstein, who in 2013 used internal proprietary data of Alliance and Bernstein to both fit an impact model and apply it to TCA. In their paper, the two authors state, practitioners use impact models as a pre-trade tool to estimate the expected transaction cost of an order and to optimize the execution strategy. To make this a bit more tangible for the viewer, below I have a mock TCA report. All the numbers are completely fictitious, and a real report would probably have even more numbers, more confidence intervals, definitely. And yeah. But the goal is not for me to go line by line in this report or even column by column. Rather, I'm going to emulate this report from a liquidity perspective when I look at liquidity risk. And the reason is this is a report that traders look at on a quarterly basis to evaluate their trades, to evaluate how their algos are doing. So this is something very tangible that traders are already used to, that they already communicate to their portfolio managers. I'll maybe give a very brief introduction to some of the columns for the readers who aren't familiar. Orders tend to be grouped by certain characteristics. So these would be the groupings on the left here. And then the three columns that are of most interest to the traders are order slippage, price impact, and alpha slippage. Order slippage because it's the objective function of the trader. The trader wants to minimize the slippage of the order. The lower the number, the better. But as anybody who does machine learning knows, it's not enough to have the objective function. You also need the gradient with respect to whatever decision variable you have available. For the trader, the main decision variable is whether to trade faster or slower. And that's where price impact and alpha slippage come into play. If most of the order slippage is due to alpha slippage, aka that means that the price move would have happened regardless of whether we traded or not, then the trader would have liked to trade faster to capture more of that alpha. Conversely, if most of the order slippage is due to price impact, due to the mechanical moves that they've caused on the price, then they would have liked to trade slower. So this illustrates how traders think about price impact, how it's used in TCA, and we're going to try to emulate similar thought processes for managing liquidity risk. On the liquidity risk side, I'm going to first quote the European regulator, the European Securities and Markets Agency. So ESMA in 2020 published guidelines on how to run liquidity stress tests. In those guidelines, ESMA states, managers using liquidity stress tests should simulate assets being liquidated in a way that reflects how the manager would liquidate assets during a period of exceptional market stress. There's a lot in those guidelines, not all of it relevant to this talk, but amongst the technical specifications in these guidelines are terms like fire sale and an emphasis on the ability to simulate these reactions from the market, these price dislocations that Bernanke mentioned. So I modified a little bit the TCA report to mock up a liquidity stress test report that would satisfy the ESMA guidelines. In that report, again, I'm not going to go through all the columns and all the rows, just as a very, I can do that in the questions, just as a very brief summary. You have three scenarios: no hedging, moderate hedging, full hedging. You obviously care about how much the hedging reduces the risk exposure. But, and this is the part that relates to the liquidity part of the liquidity stress test, you also want to be able to simulate these periods of exceptional market stress, or these reactions from the market, or these price dislocations in the terminology of the guidelines. And so in those, in this report, the way you do it is by computing the price impact due to your own hedging and the price impact due to the market reaction. And you usually want to also have a sense of how quickly these dislocations revert, because these tend to be temporary dislocations.
Kevin, can I ask you a question about hedging? Because typically we hear that word in the context of options. So what do you mean exactly by hedging? In this?
Sorry. In this case, we're not delta hedging an option. We're literally just reducing the position. So in this context, it is synonymous to liquidation. You're liquidating a position to reduce the risk. So the context here would be your risk model tells you that you have too much risk. Maybe you have too much exposure to a specific factor or just to a single stock. And you want to reduce that exposure. Mm-hmm. Does that answer your question?
Yeah. So a fire sale doesn't oblige you to liquidate it.
It does not. The term fire sale is, I guess, a little bit vague, but the idea of a fire sale is whether you're considering hedging and the rest of the market is also hedging. So it's more a question of correlated liquidation behavior. So the two aspects of fire sale is that there is either the intent to liquidate or an actual liquidation happening, and there is a contemporaneous liquidation by other market participants. If it's just you liquidating and nobody else, that would just be a standard liquidation, and there wouldn't be this fear of contagion or this high emphasis on price dislocations due to other market participants. You wouldn't have this statement here, period of exceptional market stress. And actually, if you go, again, line by line in the ESMA guidelines, they explicitly state you should not be using your vanilla optimal execution assumptions when doing one of these liquidity stress tests. You should be explicitly simulating a fire sale. Does that make sense?
Mm-hmm. Thank you.
Obviously, the two are related. Like your fire sale model shouldn't be completely different from your execution model, because otherwise, what data are you using? But there is that added ingredient of you're simulating the rest of the market as well.
Mm-hmm.
Thank you. That was a good question. I'm now going to move on to the literature review. So there's two strands of literature I need to review: the liquidity stress test literature and the price impact literature. These are going to be reasonably brief. There's obviously a larger body of work here, but the most important pieces of work are on the risk management side, the seminal work by Caccioli, Bouchaud and Farmer, where they explicitly model the effect of price impact on accounting P&L and liquidation costs, and come to the conclusion that this is very applicable to risk management. Then there are the two documents by regulators, by the US regulators, the Basel Committee, and ESMA, the European regulators. And both of them essentially stress the importance of, portraits of wood, of liquidity stress testing to avoid a situation such as the 2008-2009 financial crisis. And maybe three high-level takeaways from these documents. The first one is that these liquidity stress tests should be used. They shouldn't just be a check the box exercise. They should actually be used by decision makers. So think traders, risk managers, or higher up, and portfolio managers to make decisions on the shape of the book that they want to have. The second takeaway is that they should be simulation based. And the third takeaway is that they should be based on a simulation of price dislocations of the rest of them caused by the rest of the market. These periods of exceptional market stress, or fire sales is the term that they also sometimes use. The fourth and last document I'd like to highlight on the liquidity stress test side is a paper by Roncelli et al. For context, Roncelli is the author of the Handbook of Risk Management and therefore comes from the mathematical risk management community. So in his most recent paper, he re-implements the framework from Caccioli, Bouchaud and Farmer under from his point of view, so from his subfield of risk management, and he does so using both an empirical approach and a simulation approach. This talk can be seen as a third point of view on the same approach, more from a math finance and getting close from formulas point of view. Speaking of math finance, I'm going to anchor myself to the Obhizaeva and Wang model. So there's plenty of price impact models out there, and I picked that one because it's the easiest to get close from formulas, and it can be generalized quite a fair bit. That being said, nothing here is specific to that model. It's just the one I like to use to illustrate things. So after the original paper by Obhizaeva and Wang, which I'm going to give the shorthand OW. So after the original OW model, Jim Gatherell proved absence of price manipulation strategies for that model and many other models. And then a pair of papers I really like to highlight is a pair of papers written by Fruth, Schönebon, Urusov, where they find an alternative proof for the OW model that greatly increases both its applicability and allows the addition of lots of bells and whistles. So with this significantly simpler proof, you can generalize the model quite significantly in terms of what parameters can vary over time or be stochastic. And you can also extend the number of applications. And those papers really showcase the power of having a simpler proof. So I strongly recommend that pair of papers. The last collection of papers I recommend are the papers by Ulrich Horst. I put there one example, the 2019 one, where he and his students solve, fit, and implement on empirical data. I believe it's lobster data, the most general case of the OW model. In terms of the contributions of this talk, from a mathematical perspective, the main contribution is a more formal mathematical setup of the framework by Caccioli, Bouchaud, and Farmer. This includes definitions for various forms of P&L. So we'll see that there's multiple ways to define P&L, and they're obviously related to each other. And we'd like to relate them also to the expected closing value of a position. Out of these definitions arises a variable that will be of particular interest that I call the trading footprint of the portfolio. And the reason it's of interest is because it seems to be the variable that ties all these things together. And that is the most practical way to measure the distorting effect of price impact on accounting P&L. And finally, using that framework, I set up a simple but effective fire sale model, which allows me to populate the numbers in the report I put at the beginning. From a risk management perspective, the contributions are mostly just to illustrate, again, the points from Caccioli, Bouchaud, and Farmer. There aren't really new conclusions here, just more more illustrations of the very powerful statements made by that paper. The first statement is that the accounting P&L of a position significantly overestimates the closing value of that position. Concretely, what that means is that the number that traders and portfolio managers look at on a daily basis overestimates their final P&L. When their position closes or when they finish the trade, their P&L will deflate. The second insight from the paper is that this inflation property isn't some abstract mathematical theorem where you need to solve a very complicated, say, FBSDE to estimate it. No, this is a quantity that you can measure in real time and that I will claim you can have on your trading screens as of tomorrow. The last point, and this is an important one, is not only can you measure it in real time, but it's actionable. And the reason for that is if you have the ability to decompose losses into position inflation and permanent losses, the position inflation part are these price dislocations, which are typically temporary. And depending on your willingness to stomach risk, you may not want to lock in these losses. Conversely, if you are very risk averse, you may want to take these losses into account earlier. And I'll show that optimal execution engines don't take these losses into account. That concludes the introduction to my talk, which I appreciate is a little bit on the longer side. The next three sections of my talk are going to be more technical. I'll start with a mathematical setup. We'll formalize what I'm trying to prove. I'll then prove two examples of position inflation on special cases of the OW model. And then I'll apply my framework on concrete example of a fire sale model. In terms of my mathematical setup, I give myself a filtered probability space, and I need two spaces for my variables to live in. I give myself a space of stochastic processes, L2, and a space of functionals, L211. The reason why I need functionals is because price impact is ultimately a path-dependent functional. This slide is here so that if I get more precise questions about the nature of these functionals, I have that slide available. Once I have these spaces, I can define some variables of interest. The first variable of interest is my position Q, and its derivative or its variations will represent my traders' trades. And then as is customary in microstructure, you don't have one single price, you have multiple prices depending on what you're trying to achieve. I'll start with the observed price, which belongs in the space of functionals. So P is a function of T, omega, and Q. And the reason it is a function of Q is because of this what-if analysis I mentioned earlier, because of price impact. So P is the observed price. All the market participants agree on the observed price. Think of it as the mid price. It is observed, but it does depend on my actions on Q. If I choose Q equals 0, I then observe the unperturbed price, ST of omega. In practice, I tend to not set Q equals 0. So ST of omega is usually unobserved, but that is the price that I would have had if I hadn't traded. And so that becomes a stochastic process because it doesn't depend on Q anymore. So the gap between PT and ST is the impact of the trader. Finally, I have a transaction price, P tilde. Now, the point I'm trying to make with the transaction price is that every trader achieves a different transaction price. The transaction price includes the bid-ask spread traded, achieved, either received or paid, depending on whether you're providing or taking liquidity. But just because I see a trade at mid, say in a dark pool, doesn't mean that I can achieve that trade. Different traders, based on the quality of the algorithms, on the latency of their infrastructure, may achieve different transaction prices. So the observed price and the unperturbed price is common to all the traders, all the market participants, but the transaction price, because of the bid-ask spread, will depend on the nature of the trader, on their ability to capture certain opportunities on the market. So with these four quantities defined, I can now have my P&L. I'll start with the unambiguous part of the P&L, which is the cash account. There's no ambiguity as to what the value of my cash account is. If I have $10 in my bank account, that is the value of my cash position. So that leads to the formula above. For the full P&L, I need to value my stock position. So people who are more familiar with option pricing know this problem. Should I trust my pricing model or should I trust the prices on the market? Here, the question is, what price should I use to mark my stock position? Should I use the price including the price impact or excluding the price impact? And there's a whole continuum, partly because I could have multiple price impact models, partly because there are other ways of defining P&L. I'll focus on two definitions. The first definition is the accounting P&L. And that just means marking the stock position to the mid price, the observable price. This P&L is a canonical P&L, and it's in some sense the most practical P&L because it's model free. I can agree with my trader, with my portfolio manager, or with regulators, or with anybody on the street as to what the mid price is, and therefore what the value of my position is based on that mid price. So the accounting P&L has a definite advantage over any other measure of P&L, which is that it's model free. It's what the portfolio manager and the trader see on their screens on a daily basis, or intraday basis if they probably, because they'll monitor it more closely. But if you look at the internals of the execution engine, or if you look at any of the literature on optimal execution, and you look at the running P&L that these algorithms track, it's not the accounting P&L. Instead, what the optimal execution algorithms track is the fundamental P&L, where you subtract the impact. And that creates a gap between what the trader and portfolio manager sees and what the trading algorithm sees as the P&L of a trade. If you ask a trader, why is there a gap? Why do you see a number? And why does the execution algorithm that you use a different number? The answer usually goes along the lines that you don't want to provide an incentive to the execution algorithm to push up the price. And that's the reason why execution algorithms use the fundamental P&L, to avoid weird behaviors. Now, I'm going to define the trading footprint as the difference between these two notions of P&L. So FT is just going to be the difference between the accounting P&L that the traders see in their screen and the fundamental P&L that the trading algorithm uses to make decisions. At this point, you might ask the question, well, what's the correct P&L? You gave me two definitions. Which one's the correct one? Which one should I trust? So the good news is there's one point in time where that distinction doesn't matter, which is when I close the position. This is probably an obvious statement, but if you have no stock position, the ambiguity is lifted. All these definitions of P&L agree because there's no stock position to mark to a price. So let me give myself a stopping time t at which my position is closed. And I will call xt the closing P&L. And in some sense, the intuition that most people have is that they want to see the expected closing P&L of their position. And intuitively, you'd think that the accounting P&L is an estimate of the closing P&L of a position. And the answer is that's not the case. Now, part of that is just you need to be able to liquidate a position, but even taking into account liquidation costs, or even if you hold the position, if you don't choose not to liquidate the position, you still have this property that I call position inflation. Now, you do need some assumptions. It doesn't hold all the time. It either holds an expectation or it holds under certain conditions on your trading strategy. But my goal in the section of the talk is to provide some assumptions under which this, very common assumptions under which this inequality holds. So first, let me give myself an impact model, because it's going to be hard otherwise to prove anything. There are two cases that I care about: the original OW model, where the coefficients are constant, and the generalized OW model that Fruth, Schönebon, and Urusov look at, or that Obershorst also looks at. So both of them are linear stochastic differential equations, and either the coefficients are constant or they're stochastic. And there is a no arbitrage condition between lambda and beta for this model to make sense. There's also a self-financing equation condition that needs to be satisfied for all this to make sense. I'm not going to prove any of these statements. You can go back to these papers, or you can ask me questions at the end if these equations aren't clear, or if it's not clear where the self-financing equation comes from. With this choice of impact model, or this class of impact model, you can already start decomposing the expected closing P&L. So I give myself, again, a stopping time t at which the position is closed. And I want to evaluate the expected P&L at closing time. And what I find is that it's equal to the accounting P&L plus a number of other terms. The first term is the trading footprint, and that's going to be the first order term. Then there are two additional terms that basically capture future trading profits. So at this point, I can already say that the trading footprint is the bias that the accounting P&L introduces, because even if I suddenly stopped trading, if I just held the position and did not do any further, did not engage in any further trading activities, my accounting P&L would still be biased, a biased estimate of the closing P&L. I can be a little bit more precise. If I've captured all the alpha opportunities up to now and don't plan to do any future alpha opportunities, so the price S is a martingale from time little t to big T, and I'm not going to be particularly tactical about how I'm going to liquidate. I just have some liquidation far into the future. I'm not going to be particularly tactical about it. I'm not going to try to find the best liquidation strategy, just a standard liquidation strategy. Then you get this convergence result here, which is that the expected closing P&L converges to the fundamental P&L minus the far away liquidation costs. And so this statement shows that the fundamental P&L is a much better estimate of the final closing P&L. It's basically the estimate if you didn't plan on liquidating. And then you can always tack on an estimate of the liquidation costs, which will depend on your liquidation strategy. So at this point, this already shows that the first order effect here, when I talk about the bias that accounting P&L introduced, is measured by the trading footprint. So let me have a closer look at the trading footprint. I define it as the difference between the accounting P&L and the fundamental P&L, but it can also be rewritten as just the position times the impact state. And a powerful point here that I'd like to make, a practical point, is this is not the solution to a complicated FBSD. This is a variable that you can compute and observe in real time. I'd like to go even one step further. The trading system already computes your position in real time. Your optimal execution algorithm already computes your impact state in real time. You could therefore have this quantity on your trading screen as of tomorrow, because both of them are already computed somewhere in your trading system. The second statement is the one that I'm going to try to prove in the next section, which is that this quantity on average is positive. Again, it depends on certain assumptions. Under certain conditions, you can even show that it's almost surely positive, but in general, it's only positive in expectation. And so that's going to be the reason why accounting P&L will be biased. So let me try to prove this position inflation property. I'll start with the first case, which is more aimed at the point of view of a trader. So a trader likes to think of trades, not positions. And so typically, they like to pair up trades, have a position entering trade and a position exiting trade. And the reason is you don't know the final P&L of your trade until you exit the position. But again, they don't like thinking of a portfolio that constantly oscillates up and down. They'd rather see a position entering trade and a position exiting trade. Technically, there's no loss of generality because I can always apply an algorithm like FIFO or LIFO to match every position entering with every position exiting trade. But it is a little bit time consuming and not very practical. But from a purely trader intuition perspective, this is a very good representation of the world. There's a position entering trade, some waiting period, and then eventually the position exits. And so what I'm going to show is that during the position entering phase, if it's monotonic, we will see position inflation. And then naturally that position inflation will stay during the holding phase and will eventually evaporate either during the holding phase or during the leverage decrease phase. So even if you don't end up decreasing, liquidating the position, you will see that footprint evaporate as the price impact reverts back to zero. So let me state my mathematical proposition. So I give myself a trading process. I give myself an extended OW model. I start off from a zero impact state. And I need to make two assumptions. The first one is I enter this position monotonically. Otherwise, there might be some tactical strategies that show up. The second statement is I do need a upper bound on how quickly the mean reversion happens on the model. So under these three assumptions, I have a lower bound on the trading footprint, and it's positive. And so that's the mathematical statement, that trading footprint is positive when you enter a position. But let me take a step back here and focus on the trader intuition here. Even if your trade has no alpha, even if the price is a martingale, the trade will mechanically look profitable on average. It will actually have negative expectations because of transaction costs. But basically, you move the price by the full impact and you only pay half of the impact in transaction cost. So at least temporarily, you will look profitable. So this is this expression of illusion of profit that Bouchaud talks about. Those profits do not stay. As soon as you hold the position, it will slowly decay. Or if you liquidate the position by no price manipulation, there isn't a way to lock in these profits. Otherwise, you'd have an arbitrage, which we know is not possible. At this point, I'd like to pause to go back to the original paper by Caccioli, Bouchaud and Farmer, because they make a somewhat similar argument with a different model and not exactly the same proof. But at this point of the analysis, they ask two, in my opinion, very important practical questions, and they answer them as well. The first practical question is, when should you monitor these price dislocations, these illusions of profit? The answer to that is as early as possible. Because these are mechanical P&L moves, there's no reason for you to wait until you've accumulated these illusory profits and are forced to liquidate for some reason. So rather than doing risk management right before the liquidation, you can use these methods to anticipate these illusions of profit as you enter them. The second question is how to monitor price dislocations, how to monitor these things. And I've already answered this question, but I just want to repeat it. You already have all the building blocks in your trading system. You already have the price impact model in your execution algorithm. So the answer to the question, how to monitor these price dislocations, the answer is with little additional effort. Now I'll go back to the math. So I'll prove price inflation in a second case. The second case will be significantly less general, but it'll be a lot more practical and intuitive to portfolio managers. And the reason is, as I stated before, this whole matching algorithm between the position entering and the position ending trade, closing trade, is very intuitive to traders, but not intuitive to portfolio managers. They think of their portfolio more as in steady state. Whenever they enter a position, they have to liquidate a different position. Whenever they liquidate a position, they tend to enter a new position. And also sometimes they don't fully liquidate a position, they oscillate around some value. So again, they prefer to think of their portfolio as a whole, not as a sequence of paired trades. And they prefer to think of it not as entering and exiting, but in some kind of stationary limit. Obviously, sometimes they move away from it. They go from one stationary state to a different stationary state. And that's obviously interesting, but I'm going to treat the case where they are in the stationary limit. So I'm going to use the original OW model just so I can get close from formulas for this case, but the result can be generalized. And I'm going to have to define what it means to be a stationary portfolio. And intuitively, you have to control two things. You have to control the size of the portfolio, that's measured by QT squared, but you also have to control the turnover of the portfolio. And this should be intuitive to traders and portfolio managers. you can hold the size of the portfolio constant, but increase the turnover, and that will dramatically affect the behavior of your portfolio. In the math finance world, you can control the turnover of a portfolio by controlling the size of the impact state. There's a one-to-one map between the two, and it's mathematically more convenient to control the impact state. So I'm going to define a stationary portfolio as a portfolio for which IT squared and QT squared is constant. Under these assumptions, I can show that in the stationary limit, the trading footprint is positive, and I have a closed-form formula for it. In addition to that, because I'm in the stationary limit, I can talk about the running transaction costs in this stationary limit. And I find that these running transaction costs are proportional to the trading footprint, and the proportionality depends on the time scale of the impact model. This is a very practical result because most traders and portfolio managers have a pretty good idea of what their running transaction costs are. And so the result here is, if you know roughly what your running transaction costs are, well, just by knowing the time scale of the propagator, you get a pretty good estimate of how much your position is inflated, how much illusion of profit you have that you might lose if you start having to liquidate this position rather than stay in steady state. So that's a very important formula. We can also simulate all of this. Obviously, I have closed-form formulas, so I don't need to, but you could generalize this to models which you don't have closed-form formulas, or on empirical data, on empirical portfolios. So if I give myself a simulated portfolio, long, short, equally balanced between long and shorts, it's an Ahn-Shan-Uhlenbeck process, so I can control exactly the size of the portfolio and its turnover, the other parent, tau, and I can plot its characteristics. So you see, I successfully managed to have a constant position and to vary the turnover. And you can also see the trading footprint is always positive and is proportional to the daily transaction cost. I've picked an impact model with a time scale of 1, and therefore the two are equal, as expected. So this highlights that all of these formulas aren't just theoretical, they can be simulated on empirical data, on simulated data, and you have closed-form formulas as well. And this is a real effect. This concludes the second section of my talk, and now I'm going to apply the framework and some of these results to a fire sale model. So to begin with, I'm actually going to talk about liquidation without fire sale. And this goes back to your question, Sasha, what is a fire sale and how is that different from what does it add to the model? So I'm going to start with a standard liquidation model. Actually, it's not quite standard. In the usual liquidation or in the optimal execution literature, you start off with a 0 impact state. That's a reasonable assumption if you're entering a position. There's no reason to believe that the impact state would be biased in any way in your favor. But when you're liquidating a position, I've just spent 40 minutes trying to convince you that there's this phenomenon called position inflation, and that almost by definition, the impact state when you're starting to liquidate a position cannot be 0. It is almost always biased in your favor. And unfortunately, that's going to be painful when you liquidate it, because you're going to have inflation, you're going to have an inflated P&L, and it's going to violently decrease. The second addition, which is new compared to the optimal execution literature, is this distinction I made between accounting P&L and fundamental P&L. Because as I stated, all the optimal execution literature or your optimal execution engine maximizes the fundamental P&L, which is all good because that's the real P&L of your book. But in the short term, the risk manager might say, that doesn't match what I'm seeing. That's not the drawdown I see. And to match the drawdown you see in accounting P&L, you also need to keep track of the trading footprint. So suddenly, if you're risk averse, you may not want to minimize the trading costs. You may also want to minimize the effect on the trading footprint, because that's the short-term drawdown that you will see. On the flip side, if you are not risk averse, the trading footprint captures temporary P&L movements that you might be willing to stomach and that others might not be willing to stomach. So there's a little bit of a trade-off and different objective functions depending on whether you are willing to stomach these temporary losses or whether you are not willing to and you want to minimize the accounting P&L, the accounting drawdown as a whole. So I'm not going to interpret the coefficients because I'm partly running out of time. They could be interpreted and everything is closed form, so it's quite easy. I'm just going to give some plots. from simulations. In those plots, you can see that the dependency on the impact state is quite high. If you have a large impact state to begin with, which is typically the case, then most of the losses will be temporary because they show up in the trading footprint. Conversely, so you'll see more losses, but most of them will be temporary. If you have low to no initial impact state, again, not usually the norm, you will see lower drawdowns, but they will all be permanent. There will be no temporary aspect to them. So that's a good baseline to work with, but I haven't actually added the fire sales, the idea that other people are trading at the same time as me. And that's going to change these equations a little bit. First, I need to model the fire sale. So I'm not going to solve a Nash equilibrium where all these quantities would be endogenized because that would be hard, absolutely doable. And I, again, point to the papers by Ulrich Horst has a paper, Voss has a paper. There's a couple of papers on optimal execution as a Nash equilibrium. You'd have to modify them for the fire sale case, especially with this non-zero impact state that I think is very important for this because of this position inflation, but these are doable. I'll do the case where the partial equilibrium case, where I just give myself a candidate hedge from the rest of the market, and importantly, a candidate initial impact state from the rest of the market. And my argument there is, if I'm hedging a position and that position was inflated, and I'm assuming the rest of the market is also hedging a position, there's no reason why their position wouldn't have been inflated too. So just as important as quantifying the hedging trades from the rest of the market is also quantifying how much they've contributed to the inflation on this particular stock. And so when I do that, I get these modified P&Ls, both for the permanent part of the P&L and the temporary part, the trading footprint. Again, I'm running out of time, so I'm not going to interpret these coefficients, even though they could be interpreted as correlation terms between my trades and their trades, and everything's closed form. But again, I'll just focus on some pictures. And what these show overall is that these crowding effects, these fire sale effects, only affect the permanent part of your P&L if you're actually aggressively hedging. If you're not aggressively hedging, they will not show up in your permanent P&L. However, they will always affect your accounting P&L. The temporary part will always be affected. Even if you don't hedge, you will see a massive drawdown because of the hedge from other market participants. The question is, do you want to act upon that, or do you want to stomach it? That concludes the third section. I'm going to give 3 high-level takeaways from the talk, and then I'll open up to questions. The first takeaway, and the main one, if you had to take one thing away from this talk, is that the accounting P&L that traders and portfolio managers see on their screens overestimates the final closing P&L of their trades and positions. And from a mass finance perspective, I've only proven position inflation in 2 cases. I think there's a more general result. I think it has to be an ergodicity type result, but I think there's a more general result here at play. The second takeaway is that price impact matters for risk management. Actually, I'd go as far as say price impact is almost as important as a risk model. And the reason for that is at the end of the day, we want risk management to be actionable. And the way you act upon risk is by liquidating it. And to liquidate, you need a price impact model. The third takeaway is that managing liquidity risk starts before you end up with a illiquid position. You should be able to quantify these effects, especially these mechanical P&L movements I've just described, these biases in your P&L. These are not difficult problems. These are problems that if you have the impact model already, you can mechanically predict them ahead of time. And this concludes my talk. Thank you for listening, and I'm open to questions.
Okay, Kevin, thank you so much. So feel free to add questions in the Q&A. I have a few questions of my own, so I'll start with those. And as if we get some more questions, I'll read them from the crowd. So the first question I had was, how accurate are typical price impact models? And because I guess how precise the estimate of position inflation will depend on how good your price impact model is. Does it mean that everybody will have very different estimates of what their position inflation, or do you think that typically people tend to agree on those?
No, so that is a good question in the sense of there are definitely a lot of price impact models out there. They usually agree quite tightly on the brunt of the data, if that makes sense. So whatever your typical speed is, whatever your typical size is, most impact models across brokers or internal will agree, just because there's so much data at that granularity that you shouldn't have any problem. And all the models capture the center of the curve, whether you use a Bouchaud style parallel model or an Obhizaeva model, they will all agree. The problem is, at the end of the day, you would like to measure this for, you'd like to have the tails, both in size and in duration. So to give an example, the model fitted by Ulrich Horst provides a time scale of roughly a couple of days, let's say 2 to 3. Bouchaud tends to have models where the time scale is measured in months. For the brunt of the data, it doesn't matter. They fit the same way. But if you're looking at at risk management over longer horizons, those things start adding up. Similarly for size. So the answer to your question is, for most of use cases, there should be full agreement. But if you're pushing the envelope a little bit on either duration or size, yes, you will have to be a little bit careful, and you might have to create a specific impact model for this.
Okay, so different impact models have made this agree not just on the dollar amount or the change that the price has been impacted, but also the time over which it takes to disappear, right? Yes,
and I'd say that's actually in some sense the scarier part, because it's one thing to say, like, I have some temporary dislocation and it's X amount. You see a drawdown of Y, and you know that, let's say, half of it is temporary. It does matter whether that temporary dislocation is a couple of days or measured in like is of the order of magnitude of a month. Mm-hmm. So that does matter. But again, if you're looking at a standard order or a standard position, measuring position inflation on that should be pretty non-controversial and straightforward. Mm-hmm. So if you're just trying to debias your traders or portfolio managers, any impact model will do.
Mm-hmm. So, so if you do sort of, as you said, keep track of your position inflation using your impact model, how does it typically help a trader make a decision? So, so for example, in your picture, the one you had very earlier on, where you had these slow trading, fast trading, and middle of the road trading.
Yes.
Does this mean that exiting the trade, this one, I think one before.
So I think what you're asking is, how actionable is this?
Yeah.
From a risk management perspective, it's very actionable, because it says, these drawdowns, it's a temporary part and a permanent part, and depending on whether your objective function is to minimize the drawdown or to stomach it, you either want to act upon the drawdown or you don't. Does that make sense? Mm-hmm. From a trader and portfolio manager perspective, it's mostly a communication thing. I don't think there's that much of an action set besides not pre-celebrating a successful trade that actually isn't that successful. Does that make sense? Mm-hmm. The only actionable point, though, is for a portfolio manager who is going from one steady state to another steady state. So if you have a current turnover and size and you want to go to either a higher turnover book or a lower turnover book, you're going to have to communicate ahead of time that if you're going to a higher turnover book or higher size book, you're going to mechanically increase your P&L, and that P&L is not sustainable. You're just inflating your position. That's not P&L that's going to stay in your book. Conversely, if you're deleveraging the book either by reducing turnover or by reducing size, you will mechanically lose P&L because you're deflating that debt that you have, that position inflation. And you might want to communicate that, because otherwise people might start second guessing why you're reducing your exposure. So from a risk management perspective, I think there's a very clear action set. From a trader and portfolio manager perspective, it's mostly a communication thing. By not by understanding if your P&L is mechanical or by removing the mechanical part of the P&L, rather, you can focus on what's your actual alpha, what's your actual edge here on the trade.
So, for example, can you just go to the next one, the one that had this illustration, or rather the one that had the picture of the 3 types of impact?
Sorry, the very first one?
Yeah, exactly.
Yep.
So in these 3 scenarios, so the trading, I presume, is ending when they're most...
Yeah, at the peak. So that would be at
the end of the trade.
Yeah, exactly. So this is a very
does it imply that, you know, if I exit the trade, I may be incentivized to exit it? If I did a fast fill, that I may be incentivized to exit earlier than if I had done it slower?
Unfortunately not. So the reason for that is the no price manipulation. So you might say, hey, I have this illusion of profit and it eventually evaporates. Why shouldn't I just lock in the profits? And you can't. Basically, either lose the position, and that's part of the proof. Position inflation isn't just like, hey, you have P&L and you might be able to get it or you might not be able to. No, you always lose it. You either lose it because you hold the position and just deflates over time, or you lose the position because you liquidate it immediately. So just think of the 2 thought experiments, the 2 extremes. I hold the position for forever. By mechanically, that position inflation has to revert back down to 0. Now, the other extreme is, as soon as I enter it, I want to lock in the profit and I liquidate. Well, the no arbitrage argument tells you that that will also be 0 or even negative P&L. Does that make sense? So there is no way for you to lock in these profits. If you make profits, it has to be through some other variable, but the position inflation is called that way because there's no way for you to, these profits have no way to become permanent.
Yeah. All right. Well, in the meantime, we've got a few Q&As in the chat. So the first one is, could you give an interpretation of the coefficients from the fire sale models, which you said were like correlations?
Yes. So if you look at these extra terms here, the fundamental P&L is mostly driven by this correlation between my initial impact state and the initial impact caused by the rest of the market, and then my hedges and the hedges from the rest of the market. So the more I'm correlated with the rest of the market, the more painful this is going to be. Conversely, if I were contrarian, that would actually be beneficial to me. And then you can go a little bit further than that analysis depending on how much you choose to trade, like the relative contribution of the impact correlation versus the position correlation. I could be contributing less. I could have entered the position earlier and my footprint could have already reverted more, but I start off with a larger position, and conversely, I could be the other way around. I could be more of a higher frequency. I have a larger footprint, but a smaller position, and then that formula gives a slightly different answer. In general, the footprint is the main variable more than the position, actually. Did that answer that particular question, or is more detail needed? For the most part, you can just directly read from here that these are correlation coefficients, especially because the sorry, I should have mentioned that liquidation costs in this model are quadratic. So if I write this as a ratio of the 2 liquidation costs, I literally get a correlation coefficient.
Okay, well, John seems to say that was answered his question, and we have Marcos asking, would a running calculation of an impact adjusted meta order be helpful to calibrate the model?
So would a running calculation of impact adjusted meta order be? So I'm not 100% sure I understand the question. It seems like an interesting question. So one element I see in the question, you tell me if I'm completely missing the point here, is can I trust my regular impact model in a fire sale environment? If that is the question, I would say, unfortunately, you won't have that much data outside of your regular impact model. What you can do is in my model, the main distinction between a non-fire sale and a fire sale is the fact that you're correlated with the rest of the market. So you're going to assume that the coefficients are the same, whether the rest of the market or not is trading or not. And then what's making the transaction costs higher during a fire sale is not that the impact coefficient is higher, but that you're trading with the rest of the market. Now, in practice, most of these coefficients also scale with volatility and scale inversely with the liquidity on the order book. So they will also mechanically move up. But you will likely not have enough data to fit a model only in 2008, 2009, or similar crises. So you're going to have to make the assumption that the extra costs come from the parameters scaling up during high volatility, low liquidity regime, and from the correlation with the rest of the market. I would actually say that this approach has the advantage of you not needing to kind of bump up the impact coefficient as much during crisis periods, because you have this correlation that contributes already a fair bit. From a regulation perspective, what kind of institutions would be affected by this bias? Corporate bonds would seem to have a higher bias, so maybe insurance companies. I will admit that I don't know very much outside of equities, so I am not sure how to answer that question. I will admit the mathematics seem to me somewhat general. If you have multiple definitions of P&L, you start asking the question of which one estimates the closing P&L more accurately. But I'm not sure, besides maybe the slightly cop-out answer of if it's less liquid, then this is probably going to be more of a bigger effect. Besides that kind of standard answer, I don't have a great detailed answer. I'm sorry.
Okay, Kevin, well, thanks a lot for this really engaging talk. I really like the idea of these traders celebrating right after entering a trade, and this sort of celebration always coming, looking like maybe too optimistic a few days or maybe a few months later. And thanks for giving us the math to sort of really understand what's going on here. So, so again, thanks for the talk, and this talk will be on our YouTube channel that I've posted the link. So if you need to look at the talk a second time, that it'll be there waiting for you. And we have a few exciting talks coming up in March and April. So so stay tuned and see you on the next one.
Thank you very much.
Kevin.